Just 2 days ahead of the latest EU summit, and with the euro back above 130, you may well ask, crisis? What crisis? I'm Jamie McGeever, and this is today's Market Pulse. Well, I'm joined now by Reuters FX analyst Neil Kimberley. Neil, the euro's back at 130. Is there enough momentum, is there enough juice behind this to take it up to 131, 132?
Last time we spoke, Jamie, I said I thought 129.5, 131.5 was the range, and we're getting up to the middle of it. I think there's definitely a change of sentiment out there. A lot of interest the last couple of days from Eurozone exporters to pick up euros for hedging. Maybe they got behind over the summer, I don't know, but it's been around. Plenty of bids, 129.5, 129 the figure. Also, hearing from some central banks that they're looking to pick up some euros on dips. Now, I've got an explanation for that in a minute. But as we stand here right now, 130.20 is the key point. If we get a close above that in New York tonight, I think a lot of people are going to come in and buy it.
And we're right there, we're at 130.15 now.
Thank you. If we get a close above 130.20 in New York tonight, I think a lot of funds will have to come in and buy euros, targeting 132.15, the base of the weekly Ichimoku cloud. Now, I mentioned the central banks a minute ago. If you look at it, we've had the IMF in Tokyo. We've had all the honeyed words from Eurocrats and IMF guys about the state of the Eurozone. The chink of light at the end of the tunnel may not be an oncoming train after all. There has been some comfort given out there. At the same time, you have the Fed chairman, Ben Bernanke, standing up on Sunday saying that emerging markets must strengthen or should strengthen. Now, that can only mean, from my book, that the dollar must weaken. Now, there is a reason why the Treasury doesn't like the Fed talking about the dollar. And this is encapsulated in Mr. Bernanke at the weekend. So you have a load of central banks in the Far East with trillions of dollars now being told that their currencies should be allowed to firm up, which would mean that when they take their US assets and get them back into local currencies at some point in the future, they're going to lose money. At the same time, you've got three Fed policymakers, Kocherlakota, Williams and Evans, all talking about tolerating inflation above the 2% threshold that the Fed is targeting. So on top of the foreign exchange risk, they also face the fact that the price of their bonds could fall because the market may demand the higher yields. It's a double whammy.
So lower dollar and essentially by default higher euro.
Exactly. So if you're a central bank in Asia and you can see these risks, why would you want to hold all those dollars? Surely to God, you'd start to do something with your portfolio, reduce your dollar exposure. And as everybody knows in the marketplace, if it's all going a bit wrong, the first cut is the cheapest.
But having said that, the dollar's not going down against everything. Today, dollar yen is at its highest in a month, and the Bank of Japan Ministry of Finance hasn't spent a single cent.
No, they've got to be very happy with what they've got away with. I mean, obviously the SoftBank bid for Sprint Nextel has helped them because the market, rightly or wrongly, is assuming that will be a spot foreign exchange component. And with the big four, with four major banks lending to this deal, Mizuho, MUFG, Sumitomo and Deutsche, any time the dollar dips and the market sees one of those four on the bid, they assume, rightly or wrongly, it's got something to do with SoftBank, and therefore they go longer dollars again. At the same time, Jamie, if you buy into the argument I just put that the central banks may decide to reduce their dollars, the Americans will need the dollar yen to stay bid, because if somebody else is not buying, history shows that the Americans expect the Japanese to step up to the plate and pick up the US treasuries. I'm hearing from my own sources that on the fringes of the IMF, the US are saying, well, not only were they not opposed to the Japanese intervening on dollar yen, if the Japanese felt it necessary, they could probably live with the dollar yen significantly higher. And it wasn't until you reach levels above 90, which is miles away.
We're not even at 79 yet.
Exactly. That the administration in Washington would start to get annoyed. So dollar yen, there are all sorts of reasons for being long at the moment, and I wouldn't yet rule out the Japanese intervening because they can see the tide is going slightly in their way.
Let's finish up on perhaps a random one we don't talk about too much, the Hungarian forint. It's at its highest level in 2 months today against the euro, and I bet you, for one, are glad you're not trading anymore.
Well, Jamie, I'm very glad that you've reminded me about this in front of a global audience, because I would have done my boots on this one. I did not expect the Hungarian forint to gain this sort of traction. As we stand now, 278-ish, I'm hearing a lot of bids between 275.5 and 274. I think a lot of people who are far better at trading the forint than I am, have already got on board the trade. And they're telling me they're looking to buy back. It could be a case of buy the rumour on talks of a positive outcome of the IMF and sell the fact. Therefore, I wonder whether we're going to base out a little bit longer. But one other thing is, I mentioned the honeyed words at the IMF. You can see this also in Central Europe. You can see the foreign strength. Maybe hot money is going back into Eastern Europe. You can see also with the Serbian dinar. Not one that most people play, but it's appreciating quite strongly. It may well be that people do see some signs of life for the Eurozone.
Indeed, well, let's hope so. Neil, thank you very much. Well, all that talk of the Hungarian forint takes us nicely on to Chart Point. Today's chart is Hungary's 10-year yield, plunging to a 2-year low of 6.8%. As you can see there, as recently as June, it was as high as 9%. Finally, going on the record. Today, Britain's Office for Budget Responsibility. Last week it was the IMF. Today it's the OBR, admitting that austerity might be hurting UK growth, saying, along with many other forecasters, we significantly overestimated economic growth over the past 2 years. Fiscal consolidation may also have done more to slow growth than we assumed. That's it for now, and that was today's Market Pulse. Do check out coverage of today's Newsmaker event here at Reuters. UK Financial Services Minister Greg Clark says Britain's new financial conduct watchdog must promote banking competition. That's available on demand right now. I'm Jamie McGeever. This is Reuters.